Buy-to-let is diminishing massively for all of the reason that you've said. And there's lots of older landlords, including myself, that are exiting it because we can make our money work much better for us. Different strategies work for different areas. Is it income generation that you're looking for? Is it capital appreciation? And most capital appreciation is not appreciation, it's inflation. The margins most people work to aren't large enough. They work on 20 to 25% margin, and that isn't enough anymore. Not all development, especially new build, works in every area because of the cost of the build. The ones that work better are certainly those over £500 a square foot. It gives you more meat on the bone. And I often say when you're doing development, you want a bigger project. You do a smaller project where it's 200,000, your profit margin at 40 grand, and then all of a sudden things move, your profit's gone. So if people are starting out, what I would suggest is that
Here we go. Immanuel, welcome back to the show. How you doing?
I'm good, thank you. Thanks for having me back.
No, it's an absolute pleasure. And actually, more importantly, it's great to have you face to face, because last time we were still in the remote setup a few years back. Lots changed, so it's great to have you in person, really. We were talking before we started recording about the changing environment, really, for entrepreneurs, property investors. You've got a lot of economic factors internationally and domestically as well. Same with geopolitical changes, but it all impacts entrepreneurs in one way, shape or form. You were talking based, I guess, off that, looking at different markets, and one market you're looking at particularly is the Dubai market. Is that right?
I am looking at the Dubai market, yes.
So a lot of people, are looking at making that move. Not everyone, there's different countries as well. People are looking at making the move too, but what is it about Dubai for you? What attracts you to that location?
Where do I start? Yeah. So the first thing, it's not just the taxation. So you don't have to benefit from just the taxation part. Even if you were to stay in the UK, the Dubai landscape is very different. It's a very entrepreneurial country. There's less red tape. So as a developer, you can get to build very quickly. Also in the Dubai market compared to the UK market, in the UK as a developer, if I want to develop, I typically have to pay for the stage payments. I borrow the money from the bank. Typically 60 to 80% of the actual costs I borrow from the bank. So it's quite capital intensive in terms of borrowing. In Dubai, it's completely the reverse. You have a project or you have a development if you're going to develop, and the end user will pay you stage payments throughout your project. So the risk profile that you have is very low. So your end user, so the investor, will typically pay for the stage payments through ESCO, which means you can borrow against it. So your borrowing costs are very low and your profit margin is higher than the UK. So just on that basis, it's very attractive. So if you're a developer, to look at the developers market, when the UK, we as developers take all the risk, we take all the actual funding, it's quite reverse in Dubai. Their whole market off plan is designed where the investor pays. So typically in Dubai, if I want to buy something off plan as an investor, I will pay 20% to the developer upfront.
Wow.
I pay 4%, which is the stamp duty, to the government upfront. I'll then have stage payments during the course of the build, anywhere between 40 and 60 or 80% of the build cost. And then on completion, as the investor, I either pay the 20% or get a mortgage for the 20%. Completely arse about face compared to we are in the UK.
Yeah, it's very interesting. So you can effectively have your customers before you've had something built. So everything sold off plan. You could effectively, before you even started building a project, you could have them sold.
That's typically what happens in Dubai. So before they start building, they've already sold the project or the plot or the development on the block of flats. And I have a number of friends who've now relocated to Dubai based on that model. It's much less risk than it is in the UK. So it's a very clever model because you have your end buyer at the beginning.
Yeah. And they're helping fund the project effectively.
Yeah, and they can flip it on. So as an investor, if you buy early enough, you can flip on the project. And as an investor, you can also make your 20% developer's profit without being the developer.
Explain that. Well, because you flip it before, like, the market's moved on in that time.
Yeah, so let me typically explain. As a developer, you buy something for 600,000. You then spend 400,000 doing it up, renovating it, building it out. So the total cost is $1 million.
Mm-hmm.
Your end GDV or end gross development value or end price is between 1.2 and 1.25. So you've made your 25% margin. In Dubai, if you buy off plan, you can actually sell it to the end user. So you do the same thing. You buy it, agree at $1 million. The developer does the development for you. You flip it on at 1.25 at the end of it. So you've made your 25% as an investor without being a developer. So you get it from both sides.
Yeah. Without doing the heavy lifting and putting the spade in the ground.
Correct.
So
there's lots of other benefits as well. So I'll come on to that as well.
Yeah. So is this a supply and demand situation, basically? Like the fact that the price can move so much within a short space of time, let's say 18 months to 2 years, is that because there's just more people moving to Dubai than there is buildings being made at the moment? But there sounds like a lot of development going on over there.
So just the same as the UK, location. You have to do your fundamentals. Not all areas are going to increase like that. Not all developments are going to increase in that. So there's a lot of hype around Dubai. But if you're as old as I am, you understand the marketplace, you understand the sales dynamics. If you buy in the right location, you will get the increase. You've also got much more certainty around materials and build cost, which we don't have here. And labour is very cheap out there. So you have the consistency of the labour, and things are very, very regulated in Dubai, much more regulated than they are here. So you can deliver a project and have that consistency over a short period of time and make that profit.
And in terms of investment, looking as the investor, if you're going to hold it for long term, the buy-to-let side of it, does that still work the same way here? Do people buy them for that, or are they buying them for capital growth? Is there cash flow?
There's a mixture. So the Dubai market is a very different market to the UK market. So you have to take that into consideration to start with. Most of Dubai, probably 80%, is expats. People from all different countries that either need to live for rental or they're going to live there long term. You've got millionaires in their droves from all over the world going to Dubai because of the tax haven. They want places to live. So it's a very different kind of marketplace. So people will buy to either hold or buy to flip. And there is different phases when to buy in Dubai. Not everybody understands it. So I've spent the last 2 years understanding that marketplace to cut the chaff from the real truth and the bullshit. It can be a very lucrative market if you understand what you're buying, where you're buying. And it is very different here. There's so many different factors you have to take when you invest out there. So I said, it take me 2 years to get that knowledge. It hasn't happened overnight.
No, but I guess, you do the research slowly, carefully, and then when you pull the trigger, I guess you move fast from there, I would have thought.
Correct.
So bringing it back to the UK, we've mentioned obviously what the Dubai market looks like in terms of what strategies are working and talking about buy-to-let and investment. But buy-to-let over here, a lot of people are saying buy-to-let's dead. It's got a lot more red tape. It's getting a lot more regulation. Stamp duty has gone up. Interest rates are still high. There's been regulation changes in favour of the tenants, of course. What are your thoughts? Is buy-to-let dead in the UK?
Buy-to-let is diminishing massively for all of the reasons that you've said. And there's lots of older landlords, including myself, that are exiting it because we can make our money work much better for us. So does it work for everyone or does it not work for everyone? The answer is it's still lucrative if you're starting out. So if you need cash flow, you want to build wealth, buy-to-let still can do that if you have the right principles in place. If you're just looking for capital appreciation or appreciation through inflation, it's going to take you quite some time. You have to find a way of increasing the value of that product straight away. So you can't just buy and just hope that the small rental income of £200 to £500 is going to be sufficient. You have to add value and be able to recycle your cash. And that is becoming more difficult because of the interest rates, because of stamp duty, because of lender's arrangement fee. And a lot of people don't take that in consideration. So buy-to-let is becoming much harder for traditional standard ASTs. There are other ones that you could look at. So HMOs for sure. you're minimizing the risk, you're increasing the value. And I wouldn't say the traditional HMO of 4, 5, 6 rooms, the sui generis, where you can get a commercial value and force the appreciation. So that's just one of the areas that you could be looking at.
No, that's interesting. And that was my thought in terms of you need to be buying well more than ever, really, I find. And that's not just the below market value offers. That is, where are you going to add value at the start? Because you're less likely to get it from cash flow on a single let at the moment.
Yeah.
And you're either flipping it if you've made that value up front, or you're holding it longer term because, well, you don't know where the market's going at this point. But you mentioned HMOs there being a potentially lucrative option right now. With that in mind, which strategies in the UK in this market do you think are the best ones to lean towards right now?
So if you want more certainty around cash flow and increase your cash flow, HMO has always been a good model to work on. So if you've got 7 rooms and above, if you have one tenant not paying or a void, it doesn't affect your cash flow quite as much. Also, if you have more than 7 rooms, you can get a commercial valuation. So I'm not one of these people that believe you take a 4 or 5 or a 6 bedroom unit and get a commercial valuation. I think that's inflating the price. If you look at other houses in the road, if they are a certain price, that's what your house is worth because it's easily convertible. When you go above that, it's not so easily convertible, so you can get a commercial valuation. Now, the last year or so, people have been talking about social housing and helping the underprivileged. Yes, that can be a very lucrative market if you understand it. People are making out it's very easy, and it isn't. You have to have a lot more knowledge in that area and the sector that you're looking for. Is it vulnerable women? Is it children? Is it offenders? They all come with different complexities. I like things that are less complex for me. I said, I'm a bit older. I don't want to be bogged down with red tape and legislation. So for me, commercial is still very good. I'm not talking about commercial in the high street. There's lots of commercial that you can have that you can purchase, not just through your own name. You can purchase through very creative structures like your SASs. So garages, sheds, things that not many people will go to automatically. People think of commercial as either restaurants, offices, shops. It doesn't have to be that. There's lots of other commercial that give you very high yields of 10, 12, 15, 18% yields.
Yeah, and that is one area that I think myself I'm looking at more. And of course, always going to say this is not financial advice for people. They need to do their own research when it comes to that. But look at your SAS, look at your pension, because there's things, as you said, you can do with commercial that you can't do with residential.
Yeah.
And that is certainly something to look at. You mentioned there about the difficulty of some HMO models like emergency housing or social housing and things like that. One thing I heard is that people need to take into consideration is the mortgageability as well, because some products aren't, what you can get on the buy-to-let market isn't always going to be straight transferable for that
Correct,
market.
because it's now commercial. It's no longer residential. So you take it out of the commercial of all the different lenders you can use under residential or buy-to-let into a commercial environment. I spend a lot of time helping people navigate through facilities that were incorrect to refinance at the back end. I do a lot of work around that side, helping people restructure to the right amount. And not only that, when you go for a certain kind of social housing, what most people don't realize is that it takes time to go through the compliance check. So one of the people I've been working with, it took them 12 months to go through the compliance check. And during that 12 months, they're not allowed to rent it to anyone else. And they have to have all the systems and all the processes in place till they get authorized. The second one is a little bit faster.
Of course.
But the first one takes a long time. So they've now had a property where they're paying a mortgage. They've got a vacant property. They're paying all the bills and they have to have the right staff. So they're paying for staff costs. So the break even isn't in the first year, it's after, and they might be earning 20,000 a week.
Wow.
That's income. But then you've got the expenses, which can be 10 or 15,000 a week. So on this particular project, although the income is very high, the costs are very high, and they've made no money in the first year. And in the second year, they're likely to make a small profit. It's the third and fourth year they're making quite a lot more. Then they take on the second one, then it's accelerate it. But most people don't understand that. They don't understand the complexities of the cash flow that you need to actually have. And that was part of their learning curve, because they had the contact within the council to get the tenants, but they didn't understand the whole business model and the mechanics and the cash flow.
That's really interesting. Like you said, taking a long-term approach with it and understanding that. That's a good lesson there, that most people, when they get into property investing, don't realize that often things cost more than you think and they take longer than you think, especially on your first one. Anyway, like you said, you get more streamlined as you go along, and there's always going to be variables on each different project. But that's one that I certainly learned that factor in a little bit more time, factor in a bit more costs. Don't just put all your eggs in one basket and think that you don't need any more. You mentioned there about what strategies you think will do well in this market. Which ones do you think will do not so well?
Buy to let. Even at the lower end level of 200,000, you've got to put 25% down. You've then got your stamp duty. You've got your legal costs. You've got your broker fee. So you're adding cost automatically. And then there might be 25 or 30,000 to refurbish it. So you're putting in between 60 and 80,000 pounds at the outset. People are going to run out of money very quickly unless they can force the value to in excess of 300,000. So that way they can recycle their cash. And even that process to buy it, to refurbish it, to refinance it, it's going to take you minimum of 6 months, probably 9 to 12. So people underestimate the amount of time and how much cash flow they're going to have. So if you're thinking about the buy-to-let model, are you better off to take the 80,000 in profit today if you force the value, or are you better off to have £300 a month or £400 a month in cash flow? Where would you want to be? So I would say for most people, they'd be better off flipping it, taking the money, paying the tax, and then going again. Because it takes a long time to accumulate 80,000 from £300 or £400 or £500 amount of rent. The model has changed so much from when I first started. So the model is still there. People still need a roof over their head. But the compliance and the risk as a landlord or property investor is very different. We're not seen as helping the economy or helping the homeless. We're seen, unfortunately, by the vast majority as parasites, when we're actually doing what the government should be doing, which is providing housing for the people that can't be housed. We should be there for the private sector, for the people that want to rent, but we're also providing housing and accommodation for what the council and government should be doing. But it's never seen that way.
No, it's interesting that I agree. It seems like we're not seen as people putting stuff into the economy, you're seen as taking stuff out.
Very much
But
so.
It's, perspective.
Yeah.
You mentioned some interesting things there about, which strategy you think won't do as well right now. And someone new to this might be thinking, wow, there's a lot of red tape. Experienced entrepreneurs are looking at Dubai. I don't know which strategy to go for. Do I want £300 a month, or do I want the capital growth now, or the capital back out of that property now? What should people consider before choosing a property strategy?
That's a really good question. So the first thing I would say is the UK is still fantastic if you're starting out, because of things that we have that you can't get in other countries. For instance, leverage and gearing. The fact that you can borrow 75 or 80% of the purchase price. The fact that money is easy to refinance when you've added value. You can't do that in all countries, in all climates. And the fact that you can use other forms of money. So I use a terminology that I'm addicted to a drug. It's called opium. And people say, well, what's that? It's other people's money. And people think other people's money is finance in terms of borrowing money from somebody, but other people's money is literally, a mortgage is not your money, it's other people's money. A bank loan is other people's money, not your money. A credit card. And I've bought property, we're using all of those strategies, including investors' funds. So when you know how to access that, and you can access it relatively cheaply, you can actually grow very, very quickly. So if people are starting out, what I would suggest is that they should really think strongly about who or how they start. They should probably find somebody that's already done what they want to do and get coached or mentored or consulted by them to help them navigate and not make the mistakes that those people made we all made mistakes when we started, right? There wasn't education, there wasn't help, there wasn't support. But now we have that knowledge and experience that we can pass down to somebody that wants to start. So that's the first thing I think they should do, is understand what their business model is. So I work with a guy, very experienced, a guy called Paul Merrick, and he talks always about having a business plan at the outset. Very few people in property, including myself when I started, didn't have a business plan. When you have a business plan, so he doesn't talk about strategy, he talks about business model. Because we talk about all different strategies, buy to let, HMO, conversion, but it's not a business model. So how do you have a cookie cutter model that you can keep duplicating? And most of us, when we start, have this sort of scattergun approach to see where we think the money is, and we haven't really devised a business plan. So I'd say, yeah, that's a really great piece of advice. Start off with a business plan, what you want to achieve short term, medium term, and long term, and always look at it consistently to see if you're on track.
I think that's really important what you've just said there. And I feel a lot of people go into property, myself included, probably when I first started, was we're not looking at it as a business. We're looking at it as escaping our 9 to 5, escaping maybe something else that we've done before, and a great way to build wealth. And yes, it is, and it can be all those things. You have to look at it as a business.
Yeah. And another thing that I've noticed, including myself when I started out, we come in not as business people, we come in as investors. So we're looking at return on investment, return on purchase price, the yield, or return on the capital injected, return on capital deployed. We don't look at the roti, the nice Indian dish, return on time
Great
investment.
Dish, by the way.
Return on time investment. We don't look at it as a business as such. So a lot of people get into property, including myself. When I first started, it was to have an alternative to a pension. It wasn't done as a business. And I think if I just started off as a business, I would be in a very different place to where I am now. So that advice from Paul is a really great piece of advice.
How much does geography make a difference in deciding on your strategy? And I don't necessarily mean internationally versus like here in the UK. I mean geography within the UK. Do the same strategies work everywhere? No.
Different strategies work for different areas. So if you're looking for income, because lots of people are looking for income, then you want to go to areas that have the highest returns. So one of my colleagues, he's got a massive portfolio. In fact, when he's got one in London, but he's got another massive portfolio up north, and he gets between 25 and 30% yield.
Yeah, wow.
So in 4 years, he's got all of his money back. He doesn't care what it costs because it's an income. He's got over 200 properties based on that strategy, and they're all debt-free. A lot of those properties can't be mortgaged because they're too low in value, but they produce fantastic income. So is it income generation that you're looking for? Is it capital appreciation? So capital appreciation, we can't determine. And most capital appreciation is not appreciation, it's inflation. So appreciation is where you do a specific amount of work and it increases in value because of the value that you've added to it. So for instance, you take a 1-bedroom apartment to a 2-bedroom. You take a 2-bedroom to a 3-bedroom. You take a house and you do a loft conversion, a rear extension. How have you added the value to force that appreciation? Most property inflation is through inflation. I didn't consider that until quite some time. When you look back at it, what would the same amount of money have done if you had invested it elsewhere? Because not all properties increased. And people talk about property increases or doubled in value. It hasn't happened for a while.
No, and you're so right about the inflation thing, and it's not something everyone looks at. If you look at what inflation's done over the last 5 years versus how much your property's gone up in the last 5 years, if it's similar, then like you said, it's not value you've created.
Correct.
It's inflation. And to your point about, well, are you investing for cash flow versus are you investing for capital growth? Capital growth is harder to predict, but I guess if you look back at the fundamentals, are you buying in the town that is seeing industry growth, population growth, etc.? Tick at least those boxes and things like that. But if you're just going to end up with a few £100 at the end of it and your capital locked in that property, then I guess you've really got to think about why you're doing the investment, I guess.
Yeah. The stuff that I do now is for end users, not for investors.
Right.
So if I'm going to do a refurbishment or a development, it's going to be specifically for an end user purchaser, not for rental.
What types of, can you give us an example of a project that you've either done recently or you're looking to do, and we can go through that a little bit more?
Yeah, I can talk about a couple of bungalows that I've done.
So is that UK? Is that stuff that you're still doing in the UK?
The UK.
Yeah.
So bought some bungalows, converted the loft space, did a rear extension. It's for an end user. They're going to be people downsizing. There's a very high demand for it. Sold within a few weeks. So it's knowing where the value is and who your end user is. And I think quite often we don't look who the end user is. We think it's going to be an investor, but typically it isn't, especially when you're doing smaller end of projects. So now a lot of it is done at the front end to work out who is going to be the end user, and then working out multiple exit strategies in case the market changes, in case interest rates change, in case values change. As an investor, what I find is the margins most people work to aren't large enough. They work on 20 to 25% margin, and that isn't enough anymore.
25% margins isn't enough right now in development. A lot of people are saying something similar. Why is that not enough anymore?
I'll tell you why it's not enough. So any project that you do always ends up to take longer and costs more. And then if the market conditions change and you need to refinance, you need to be able to refinance and pull all or most of your money out. If you don't have the 25% in there and you have an increased cost, delays, interest rates increase, all of a sudden your margin has gone down from 25 to maybe 15, 16%. It's a very small amount of money for the amount of risk that you take. And again, I'll go back to Paul. He's got some very good phrases. And one of those, when you do development, most developers, when they go to see a landowner, they say your property's worth $1 million. We'll give you an option agreement. When we get planning, we'll give you 1.3 or 1.4. So we're taking all the risk, we're putting all the money in, and we're giving them the benefit of the risk that we've taken. So it's looking at a model which is different to giving the landowner the value that you've created for obtaining planning and you getting the full value. And a lot of agents still work on that basis. You get the planning and you still get your 20, 25%. On those ones, I want to be making 40, 45, 50% to take into account the risk and the time for getting planning and getting that development.
You've mentioned two things there that I've picked up on throughout this conversation: time, effort, risk. You factor that very much into decision making on what type of deals you're going to do. As someone who could probably do a new build of, or has done, blocks of flats, new build houses and things like that, you mentioned bungalow conversions there, and you mentioned the speed of which you can do them, and I guess the certainty. I assume you're doing it under PD, going up into the loft and things like that. You know exactly who your end user is. How important is it to manage those things for you?
So, having done a lot of developments and having the ability to have ones that work well and the ones that didn't, when you have something that's airtight and watertight, you have much more certainty of your build time and your exit. When you're coming out of the ground and you don't know what your land or your foundation is going to be, how deep you need to go, what the ground conditions are, what the weather conditions are going to be. If you're building basements, they take so much more time than you realize. They cost much more than you anticipated. So everything gets changed. Your build time, your cost, your end value. Has the market moved up? Has it moved down? You need more certainty. So I want more certainty. I said, I am much older now, so I want to be less risk averse. When you're younger, you have more time to recoup any mistakes you've made. As you get older, you want to make less mistakes because you haven't got as much time to recoup it.
But I think a lot of people would agree with that. If I could get in and out of a deal quicker with getting just as good margins and less risk, then I'm going to take it. I also find with certain stock as well, you can't buy the land and build it. cheaper than what you could buy existing and just
Correct.
refurb sometimes.
So not all development, especially new build, works in every area because of the cost of the build. So let's talk about the cost of the build, because this is one thing that people mostly get wrong. From all the projects I've seen and the stuff that comes across my desk, either from an agent or somebody asking for funding, whether it be a soft loan, a hard loan, JV finance, their build costs are all over the place. So when it comes to new build, I often see stuff coming in at £120 a square foot, up to maybe 160. For most places, that isn't viable. Then you got the cost of finance. Then you got the buying cost, and you've got the selling cost. Then you got the cost of acquisition, or the cost. And if you've got a price of, say, £300 a square foot is the end value. So as a developer, you want to have your 20% margin minimum. So from 300, take your 20%, that's your £60 plus finance cost. You're going to be at around about £100 difference. So it's then at 200.
Mm-hmm.
Your build cost, if they're 160, leaves you your land acquisition at 40. There isn't much land you can buy today at £40 a square foot. So not all areas work. The ones that work better are certainly those over £500 a square foot. It gives you more meat on the bone. And I often say when you're doing development, you want a bigger project. So you want to do a project that's 4 or 5 million. If you're working 20-25%, you've got $1 million in there. You've got some room for movement if prices change, both in terms of materials, labour, GDV. If you lose 10%, that brings you down to 900. You lose 20%, it's 800,000. You do a smaller project where it's 200,000 and you've got your profit margin at 40 grand, and then all of a sudden things move, your profit's gone. You've done the same amount of work, but all of a sudden the margin you have is so much more diminished. So it's better to go big or go home.
Well, that's interesting you say that, because, naturally your tendency, again, depends on your risk profile. People might want to start with something small, but like you said about the margins, with something bigger, you can fill the gaps of knowledge with consultants and bring other people on board, right? Because there's a bigger piece of the pie. So like you said, if you want to build one house versus, I mean, personally, I would never build one house. I'd build, a minimum of 3 or 4 or whatever. You can bring in the best architects, you can bring in the best consultants, people who've got to look at the ground and everything like that. And you'll still have the margin you're looking for afterwards, in my opinion.
So let me give you a client I've been working with recently. So they came to me following one of these podcasts, funny enough, and he's got a really very nice scheme that he got planning for in, let's say, the Enfield area. I won't give it out completely.
Okay, yeah.
So he got planning for 2 detached houses and 2 semis. He came to me to have a look at it to help him navigate it. A sale had just fallen through, and one of the reasons why it fell through, when they did their own due diligence on it, the cost to build was too high. So he brought the scheme to me, and it was a terrible scheme in how it was designed. It was designed by an architect for architecture, not commercially, and that often happens between the architect, the structural engineer. They look at what the client says they want, but not what is commercially minded. So I've worked with the client for about 5 months now. We've changed the design completely. If we were just done the build as he wanted it to, literally within a few weeks, we saved over 200,000 on the build cost. Now that I've actually worked on it, changed the design, configuration, we've got rid of the basements. There's a saving of about 800,000 on the project. So from being non-commercially viable, it's now in a very strong position, whether he wants to build it or sell it, to have something that's much more attractive. So although he worked with professionals, he himself wasn't a professional. It's his first project. And you don't know what you don't know. So if you don't know what you don't know, what don't you know? He didn't know the things that make something commercially viable and more buildable, so he can actually exit from it. So from a scheme that he probably would have lost money on, he's now going to make money and walk away unscathed. And that's a lot of the stuff that I do. I help people that aren't inexperience that take on a project and they don't know what they don't know, because development is a very different animal. So if you go from a basic refurb or conversion to new build, oh my God, it's completely different. And if you think you have the skills to do that, and there's so many different trades and professionals that you need to engage, that it's a huge task. And I would say to anybody starting development, do not do it on your own. You're better off to do a JV with somebody already, earn less to learn the skill. There's no substitute, and learning on the job is not a good way, because if you get something wrong, so he put a lot of money on that particular project if he built it out.
That's interesting you say it. I completely agree, by the way, and that's how I first got into development. I partnered with people more experienced than me, took less of an interest in it, but you learn so much.
Yeah.
One particular joint venture, I learned a lot from a builder developer. Funny enough, you said on the design, we had great architects, but all of a sudden he rejigged it, like you said. Even little things from putting first floor bathrooms and ground floor bathrooms in the same location, so you've got all the soil stacks and everything going on out the same place, or unnecessary design that isn't really needed, or even just if you've got a big plot of land, you don't always have to put the houses so far away from each other, because the services have to run all there, the roads have to run all there, and everything, and all these little tips and tricks that you're not going to know if you're new to it. So yeah, completely agree with being partnered with more experienced people and learning the craft and putting the effort in from that point of view, really.
Yeah.
Last question, Immanuel, you shared so much value today, but I wondered if there's anything you've changed your mind on recently. So I find entrepreneurs are more susceptible to change in direction when they need to and things like that. And I wonder if there's anything particular you changed your mind on, something you used to believe that you no longer believe, maybe even since we've last met.
I think for me, over the last 2 years, being more open to exploring overseas like Dubai, and to look at the landscape and researching it myself to see what is true and what is possible, compared to the UK, which I don't feel is the same as it was as a property professional entrepreneur. The landscape has changed so much. The time it takes to get things through planning, the red tape, the compliance, it's so much harder to navigate. So for me now, I've changed my focus from developing myself to helping other people develop, giving my skills to them to allow the younger generation to come through and help them navigate it, and then use the skills that I've got in a market that's more receptive to an entrepreneur like myself. So that's where my focus has been really the last couple of years, helping people navigate through their own projects, their own developments, helping them with financing, restructuring, using all the skills I've accumulated over the last 40 years to help the new generation come through.
Emmanuel, I really appreciate it. Thank you for your time as always.
Pleasure.
You always share so much value. And if people want to find and follow you, where can they get hold of you?
Easiest place is LinkedIn. I do have my own website called immanuelezekiel.co.uk, but LinkedIn is probably the best. Facebook, Instagram, but LinkedIn for sure is probably the best place.
Brilliant. Well, I appreciate it. Thanks again, and we'll catch up soon.
Thank you.